What is an option? What does it actually mean to trade options? In this video, I will explain the basics of options trading by explaining put and call options in a simple and easy to understand way. The most important thing to know about options is that one option contract is worth 100 shares. I'll tell you a little story to demonstrate how options work. Hey Deltas, let's start with a simple example of how a call option works. Sandra is selling her house for $600,000 in a neighborhood that has a nearby piece of land for sale. There are two parties interested in the nearby property. Paul, who plans to develop the area into a beautiful park and place to relax from the stresses of everyday life, and Tom, who wants to build a low-cost housing development. Now Peter comes along and is interested in buying Sandra's house for a cash deal, but he has a problem. He won't have the cash for the next 3 months. So, of course, he's worried that the house will sell because someone else will buy it in the meantime, so he decides to offer Sandra $10,000, or the option premium. Right now, if she will take the house off the market and give him the option, this would be a call option to buy the house for $600,000, which is referred to as the strike price anytime within the next 3 months, which is the expiration date. If he does not exercise his right to buy the house, Sandra keeps the $10,000 premium and Peter walks away from the deal. If, on the other hand, he exercises the option, Sandra still gets to keep the $10,000 and he pays her $600,000 for the house. Now, 3 things could happen in this scenario. First, Paul buys the nearby property. This will of course increase the value of Sandra's house to, say, $800,000, in which case Peter will be very happy to exercise his option to buy the house for $600,000. In scenario 2, Tom buys the nearby lot and will build low-cost houses. This will reduce the value of Sandra's house to, say, $400,000, in which case Peter will not exercise his option to buy at $600,000. He'll just walk away from the deal, having only lost $10,000. Then there's scenario 3, where neither Paul nor Tom buys the nearby parcel of land. Sandra's house is still worth $600,000, and Peter can choose to exercise the option to buy the house for $600,000, or not exercise his right and simply walk away from the deal, losing only $10,000. Peter controls a $600,000 asset for 3 months for only $10,000. No matter what happens during that time, the most he can lose is $10,000. Sandra, on the other hand, is happy to take the $10,000 because she had no guarantee that anyone else would buy the house at her asking price, nor did she feel that the nearby property would sell anytime soon. Here's a side note to the story, depending on the circumstances. If Sandra felt she was likely to attract another buyer in the near future, she would have asked Peter for more than $10,000 to take the house off the market for 3 months. Similarly, with call options, the higher the perceived value of the underlying asset, the higher the premium the market will demand for that call option. Now, let's define this in trading terms and look at a specific example. A call option is a contract between 2 parties. One party, the buyer of the call, has the right but not the obligation to buy the stock at the strike price on the future date. The other party, the seller of the call, has the obligation to sell the stock to the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $80 and you think it's going to go to $90, you might buy an $85 call option for, say, 20 cents. If the stock rises to $90, you can buy the stock at $85 even though it's worth $90, giving you a profit of $4.80 on each share. On the other hand, the person who sold you the call would be obligated to sell you the stock at $85 for a loss of $4.80 per share. If the stock never rises above $85 by the expiration date, the call expires worthless, and the call buyer is out 20 cents and the call seller keeps the 20 cents. Now, let's look at how put options work by revisiting Sandra and Peter from our earlier story. Peter owns a car worth $80,000 and he's worried that his car might be damaged in an accident or even stolen. So Peter decides to buy a zero-deductible insurance policy, or put option, on the car for the full $80,000, which would be the strike price, from Sandra's car insurance company. If you want to ensure your path to trading success, subscribe to my channel and hit that like button so I can help you protect your capital with valuable videos. Sandra charges him $2,000, which would be the option premium for a one-year policy. 3 things could happen after year 1, the expiration date, in this story. In the first scenario, Peter's car is not damaged or stolen during the year. Sandra keeps the $2,000 premium. Peter is okay with losing the $2,000 for the protection it provided him for the year. In scenario 2, Peter's car is damaged in an accident and requires $20,000 in repairs. He exercises his insurance policy, or put option, by filing a claim. Sandra pays him $20,000 for the repair as agreed. Peter is happy that he purchased protection against this possibility. In the third scenario, Peter's car is stolen. He exercises his insurance policy, which is his put option, and files a claim, but this time for the full replacement value of his car. Sandra pays him the full $80,000 to buy a new car. Peter, of course, is very happy because he bought protection against this possibility. Sandra is happy because she has sold many such policies or put options to other drivers, most of whom never file a claim or never exercise their options, giving her an overall net profit. Here's a side note to this story. If Peter had a bad driving record, that's more risk for Sandra, so she would have charged him more than $2,000 for the one-year policy. On the other hand, if Peter had an exemplary driving record, Sandra could have charged him less because the risk would be lower. Similarly, with put option, the higher the perceived risk, the higher the premium the market will demand. Let's look again at a definition and a practice example. A put option is a contract between 2 parties to exchange a stock, ETF, etc., at a strike price by a predetermined date. One party, the buyer of the put, has the right, but not the obligation, to sell the stock at the strike price by the future date. The other party, the seller of the put, has the obligation to buy the stock from the buyer at the strike price if the buyer exercises the option. For example, if a stock is trading at $80 and you think it's going to go down to $70, you could buy a $75 put option for, say, 20 cents. If the stock drops to $70, this would allow you to sell the stock for $75, even though it's worth $70. This gives you a profit of $4.80 on each share. On the other hand, the person who sold you the put would be obligated to buy the stock from you at $75 at a loss of $4.80. If the stock never falls below $75 by the expiration date, the put expires worthless and the put buyer is out 20 cents and the put seller keeps the 20 cents. Thanks for watching. If you found value in this video and want to accelerate your path to trading success, subscribe and hit that like button to get more videos like that. You want me to cover a specific topic or have a question? Let me know in the comments below.